approach because most of the time you have basic theory, and that's it. But in Prime Academy, we value experience that you will get trading experience from the day one, because it's all about the hours spent in front of the charts, hours spent trading, that will get you to this level of proficiency, that you will be able to call yourself a professional trader. By the way, I am a professional trader. I trade for a living on a real account. Of course, you cannot be a professional trader if you trade on a demo account. And I do that for many years. Recently, I cooperate with Prime Academy, and I'm sharing my knowledge to the clients of Prime Quotes, because, well, mostly trading is a lonely journey. You're spending hours in front of the screens alone with the charts, and it's really a passionate journey, but you want to share sometimes this journey with someone, and this knowledge with someone, not just look at the charts by yourself. So without a further ado, let me start with the presentation, right? So today we will talk about basics of the market. First of all, what is Forex market? What is in general Forex trading? And by the way, if you have any questions, of course you can ask now, but maybe let's wait until the end of the presentation, and you will have time to ask some questions. I will answer those questions, and then we will move to the charts. So Forex is a shortcut from foreign exchange, right? So it's a market where you trade currencies against each other. Um, you participated in the Forex market, even if you didn't trade on the Forex market, you still participated when, for example, going abroad, you were buying dollars, buying euro. This is a participation in the Forex market, not trading on the Forex market as we understand uh, when opening a platform, trading platform, but still you participated in exchange of the currencies. Um, that's the core of the Forex market. But in Prime Quotes, we don't limit ourselves only to currencies. On Prime Quotes, you can also trade commodities, indices. You can also trade cryptocurrencies, stocks. So a lot of other instruments. So Forex is a currency exchange, but thanks to CFD contracts for difference, you can trade other instruments as well. So it's by far the largest financial market in the world, with a daily turnover exceeding $6 trillion. So it's absolutely huge. And why it's so huge? Well, because not only we participate in this market, right? It's huge because you have a lot of market participants. You have big banks, hedge funds, governments. We as retail traders, we are just a small part of this huge market. So Forex market is open 24 hours during weekdays. Okay, it's closed for the weekends. Luckily, because otherwise we would be totally addicted to trading. If you want to trade on the weekends, you can trade cryptocurrencies, but I think having 2 days off is very beneficial. You can work on your strategy. You can read again your trading journal, go through your trades that you made during the week, and this can be beneficial for you. And 2 days of taking a break from trading is also beneficial. Okay, the thing is, it's a huge market. It's a very liquid market. What it means that it's liquid, it means that there's a lot of money floating around on this market. And the reason for that is because you have so many market participants with huge amount of money, governments, big banks, hedge funds, institutional investors, all that all those participants guarantee that there is a huge liquidity, and you can compare it, for example, to your local stock exchange, right, where you can trade some small companies, and sometimes you don't even have a trade during a day. So this particular company is not traded for a day, which means that the liquidity is really low. All right. On the Forex market, you have huge liquidity, so you can always open a position. There always will be as another side of the market. So if you're buying, there always will be someone who is selling, and if you're selling, there's always will be someone who wants to buy from you, and this is really amazing. Important thing in the Forex is the use of the leverage. It may be a difficult concept at first, but to understand leverage, you need to know that it is perceived that Forex market is really volatile, right? So that there are huge changes every single day. It is not true. Forex seems volatile because of the leverage, okay? What is leverage? I will tell you soon in a few sentences. But Forex market is not really volatile. Is liquid, but is not volatile. What does it mean? Is volatile? Daily changes are rather small. So currencies, for example, euro to American dollar, change every day. For example, 0.5%, 0.2%. If there is a change of 2%, for example, that means that something huge had to happen. There was the data publication, or central banker said something, or there was a change in interest rates, unexpected change in interest rates. So this can cause huge volatility. On the stock market, if stock moves 2% in a day, it's nothing. It does not mean anything. Look at the cryptocurrencies. It can have a move of 10% a day, and nothing happens. It's normal for cryptocurrency traders. So Forex market is not volatile. And because it's not volatile, and in order to be able to earn money on those small movements, because currency pairs change 0.2% a day, for example, in order to be able to make money on those small movements, the concept of leverage was introduced. Leverage is pretty much the thing which allows you to trade with much larger capital than you originally have. So it allows people with small accounts to trade much bigger money. It allows us to trade much bigger money because then we are able to make sensible trades, reasonable trades, and make some reasonable money on the changes, using the changes of 0.2%, for example, right? It would be really hard to trade without a leverage and earn 0.2% a day if you will be able to capture whole move. You buy at the very bottom of the day and sell at the very top of the day, and that's 0.2%. Nobody would be interested in that. So thanks to the leverage, you can increase the position size and use this leverage in order to make bigger gains, because when you have a small account and then you use leverage, and then you control much bigger amount of money. So instead of earning 0.2% a day, you can earn 5 or 10% a day. Okay. Of course, you can also lose, because market goes both ways. You can as easily earn money as easily lose money. But we are here on this webinar. You are educating yourself in order for you not to lose money fast. And I will help you with that, because the main aim of trading, the main thing what professional traders do is they don't lose money. That's first. Making money is second, but first is not losing money, and don't forget about that. Amazing thing about the forex market is that you can totally go both ways. Like in the stock market, yes, you can short stocks, but in general, in the stock market, people buy stocks, right? Very seldom you go short. If you go short on indices, you go short on commodities, and going short means selling. But on the forex market, it's always one currency pair against another currency pair, which means that if you're selling you're selling the first one and buying the second one. Okay, and those can be reverted. So it can be American dollar to Japanese yen, but it can be Japanese yen to American dollar. And one currency has to go up, and another one has to go down. And when there is a recession, for example, stocks are going lower, indices are going lower, people are panicking. There's no recession on the forex market. No, currencies just change the values. You can, if there is a recession, safe haven currencies like British pound, Swiss franc or Japanese yen, they gain in value. Okay, so you can just easy buy those safe haven currencies and make money on this. So it's pretty amazing feature. About the currency pairs, as I said, you trade currency pairs, so two currencies against each other. There's two currencies, the first one and the second one, base currency and quote currency. For example, euro, USD, you are, if you go long, if you buy euro against USD. If you sell, you buy dollar against euro. Okay. As for the major currency pairs, major means that they are most popular, most widely traded, and those are euro, American dollar, Japanese yen, Swiss franc, British pound, and yes, they are less volatile generally, and sometimes there's a correlation that less volatility comes from the higher liquidity. They are liquid because there's a lot of money being traded there, so they are less volatile, which leads to the thing that the spreads are narrow. What are the spreads? Well, spread is a difference between buy price and sell price. Okay, as you can see, for example, on stocks, sometimes the difference between buy and sell price is big. I don't know if you looked on the spreadsheet of stock trading when you want to buy or sell. For example, you have stock which is generally trading at $100. The thing is that when you want to buy and sell, it's not like $100 1 cent and $100 2 cents. No, the spreads are much bigger. So, for example, you can buy at $100.5 and you can sell at $99.6. Okay, so that's the spread. That's the difference between buy and sell price. On the forex market, on those major pairs, the most popular pairs, this spread is lower, and spread is the actual price, the actual commission that you have to pay when trading. In general, there is no fee, no commission, depending, of course, from the instruments and from the platform. Like in Market Maker, MT4, there is no commission. On MT5 or ECN. ECN can be, of course, an MT4, but in this market, in this model of a platform, ECN, where you have a direct access to the market, there is a commission. So you pay commission and you pay spread. Why? Because, for example, if there was no spread, you would be able to buy and sell in the same second and you would make money, right? But if you buy and want to sell in the same second, well, you lose money because there is a spread. That's what I wanted to also show you why there are two prices on the market. What does it mean? And I give you some hints 2 minutes ago, but let me explain you that clear because it's very important. So we have a currency pair, in this case, British pound to American dollar, which means that you have a base and quote currency. Base is the first one, and quote currency is the second one. And the price shows how much of the quote currency is needed to purchase 1 unit of the base currency. So if euro dollar is 1.20, it means that 1 euro is equivalent to 1.20 dollars. So it means that dollar is less valuable than euro, and that's the reality. And spreads, difference between the bid and sell price, that's the fee that you have to pay. What also, let me show you also here. You can see a spread in the middle, but on the lower here you can see swap. What is swap? Swap is difference in interest rates. Is a fee that you have to pay based on the difference of the interest rates. So as you probably know, because your currency has a certain interest rate, depending from which country you're coming from. But let's say Canada 5.5%. Let's say just recently, half an hour, 50 minutes ago, we had inflation number from Canada slightly lower than expected. That's why I'm thinking about the Canadian dollar. So let's say interest rate is 5%. When you buy a currency with higher interest rate and you sell currency with lower interest rate, swap should be generally positive. So by buying currency with higher interest rate, you are able to generate extra income apart from this profit coming directly from the trade. Okay, just by having in your portfolio a currency with higher interest rate. If on the other side you're buying a currency with lower interest rate, using currency with higher interest rate, the money will be deducted from your account. You will pay swap. Very popular, clear example is buying Swiss franc or buying Japanese yen. Those currencies have low interest rates. Almost all other currencies have higher interest rates than Japanese yen and Swiss franc. So if you, for example, have American dollar to Japanese yen, where you buy dollar, you should be earning money with the swap. If you sell the American dollar and buy Japanese yen, you will be paying swap, so money will be deducted from your account. Why price moves? Well, in general, the price moves because, for example, when the price goes up, it means that there's more buyers than the sellers. If the price goes down, it means that there's more sellers than buyers. Okay, it's pretty simple. But why people are buying and why people are selling those particular currencies? We have many factors influencing the price moves, the price movements, and you will never guess which factor is currently pulling or pushing the price. It's unknown. That's why, in general, it's pretty impossible to predict the future market movement. So trading is a game of probabilities. Okay, it means that there is a higher chance that the price will go up or the higher chance that the price will go down in the nearest future. And as a trader, you will be playing the game of probabilities. You never can be certain that the price will for sure go up or down in the next hour, day, or a week. Whoever is telling you that he's absolutely certain that the price will go up or down lies, because you never can be certain. If somebody is claiming that he's a professional trader and he's telling you for sure the price will go up, that is pure bullshit, because you never can be sure what the price will do. Let's imagine this. You are buying dollar and you say the next week dollar will be higher for sure. And in the meantime, Donald Trump tweets that Federal Reserve should lower interest rates and dollar is too strong and should be weaker. I mean, Donald Trump, when he was a president, now Joe Biden is tweeting something like this, and dollar collapses pretty much after such a tweet. You cannot say that it will never happen. It can happen. So price movements in general are unpredictable. But if you're thinking, okay, how can I make money based on the fact that market moves are unpredictable? Well, it means that you never can be certain that something will happen in the future for sure, but with some possibility, you can say that the price will be higher or lower. All you need is be a possibility higher than 51%. And with proper money management and risk control, you can make money on it. But using technical analysis, fundamentals, etc., you have much higher edge, and this is edge. You get much higher edge than that, and you can say, for example, you can think 70, 30% that this scenario will happen. But you still need to protect yourself from this, what will happen during this 30% scenario. I have to come back to the topic. Sorry. What drives the Forex market? There is a lot of factors. So, for example, economic indicators, inflation, GDP growth, industrial production, retail sales, PMIs, all that data which can be found in the macro calendar. And when you will trade, you have to take a look on the macro calendar. And I will show you precisely in 5 minutes or so, when I will show you the charts, why it's important. Because, as I said, we just had inflation number from Canada, slightly lower than expectations, and Canadian dollar lost in value. And you will be able to see the market reaction, rapid market reaction on the chart. Elections, policy changes, geopolitical tensions, all the political events also influence the markets. Brexit, US elections, everything. Market sentiment, also traders' perceptions and reactions to news and global events, what they think that will happen, what they think that will not happen. Everything can influence the markets. Choosing a Forex broker, it's very important. For example, you have one particular instrument that you would like to focus on, like, for example, gold. Choose a Forex broker which has gold in offer. Almost everyone has, but the best conditions to trade gold, lowest spreads, lowest fee. The most important thing in choosing a Forex broker is safety of your funds. Of course, when you deposit money and you make money, you want to withdraw profits, your money, whole deposit maybe, and you want it to happen fast. That's why you need to choose reliable broker, like, for example, Prime Quotes. You have basic Forex strategies which you can use to trade. And you can be a day trader, you can be a swing trader, you can be a position trader, you can do price action, you can focus on indicators, you can trade moon phases, whatever, really. I have to tell you that trading strategy is only 20-30% of success. 70% is trading psychology and money management and risk control. This is the key. And I will tell you more about that when I will analyze the market live soon. But this is really the key. If you peak day trading, okay, fair enough. You will have to sit many hours in front of the computer every day and try to earn 5 pips, 10 pips on every single position. It's really demanding. It's hard. I know it looks awesome that you sit in front of 3 screens and you can do it, but I personally choose swing trading. I'm a price action swing trader, which means I have my positions open for a few days, even weeks. I trade really few hours a day, not more. I wake up very early in the morning, prepare setups, look at the charts like 6 a.m. I'm already in front of the charts. That's the thing with trading. You have to know that um it's very uncommon to wake up and do work first thing in the morning. You try to avoid or delay the work. But with trading, it's awesome. I just wake up, make a coffee, and sit in front of the screen straight away because I love it. And 6 a.m. is not a problem for me to actually. I cannot wait to sit and see the charts. Uh, you can also be a position trader, which is common for stocks. Mostly for stocks, you buy a stock and you forget, you keep it for a week, month, few years, and then after some time you check the potential profit that you made on those. Personally, again, I'm a swing trader. Risk management. So yes, it should not look like this on this video. Risk management is absolutely key. It allows you to stay on the market for a long period of time. If you're staying on the market for a long period of time, it means that you can learn a lot, a lot. If you don't have a risk management and money management, sometimes after 5 trades, you can be gone from the market because you will trade bad and you will lose all your capital. With proper money management and risk control, you can have 100 trades before something bad will happen, which gives you 100 trades of a lesson, of experience, which is priceless. Okay? Risk management will allow you to be on the market for a long time, which will be many occasions to improve, to learn, to earn money, really. Stop loss orders, absolutely crucial. So you have to use stop loss orders. I will show you how, when. They close your position when you're simply wrong. And you can be wrong at any times because, as I said, market moves randomly. You can have an edge over the market, make money on the market, but at the end of the day, market moves randomly. And position size is really key. Positions should be small. It will allow you to be on this market for a long period of time. Now you're in a learning phase, and I totally love it. Use it. Use your learning phase to make to learn as much as possible. Thank you for coming on this webinar. It's part of your learning process. But don't stop there. I urge you to buy books of Mark Douglas. They talk about trading psychology. Don't neglect trading psychology. This is absolute key. Trading psychology is the #1 thing that you should focus on. He wrote Trading in the Zone and The Disciplined Trader. Those 2 books you should read, period. Simple as that. Very seldom. I don't think you can become a great professional trader without knowing what is written in the book in those books. Maybe you know it without reading them, but it would be still nice for you to read them and just to confirm, okay, I know it, I'm aware of this. Okay. Also try Japanese candlestick charting techniques by Steve Neeson, absolute Bible for those who want to trade candles, and I recommend you to trade candles. Websites, Forex Factory, great website with the macro calendar. Use it for seeing the macro data, and start trading as soon as possible, but of course with demo account first, just to find out how the market moves. But remember, on the demo account, you don't learn trading psychology. Trading psychology is the key. So you have to move to real account as soon as you will figure out strategy. And it's not that hard. Strategies are really simple. Once you figure out the strategy, you move to the real account and then you work on trading psychology, money management, and risk control on those things that counts. Okay, do we have any questions? You can type on the chat if you have any questions. If not, then let me show you my platform. So this is my trading account with Prime quotes. I used it the last time. I'm still using it. I'm constantly using it, as you can see on the toolbox window, because I have three positions open. But I opened it for trading with Mr. Pips from Vietnam. We had a trading competition on non-farm payrolls, key data from the US job market. And it was for $10,000. Now it's $14,000. It's been 3 weeks since that. So you can see 40% profit in 3 weeks. Of course, it's not my only account. I have more. It would be hard to be a professional trader with an account of $10,000, as you may imagine. But this is my account for Prime quotes. I will use it also to provide signals for you. So we will have signal service. We will have a Telegram channel where I will post my trading ideas for you. So please contact our representative in Prime Quotes, and they will direct you to our Telegram channel, where you will be able to join and follow my trades. Also, you can see my analysis on Prime Academy website, free analysis a day, a lot of trading insights. But let's apply what we learned so far on the real market. So this is trading platform. This is MetaTrader 5. You can see Market Watch, a list of instruments which you can trade. So you can see that we have stocks. We have also currency pairs. We have also cryptocurrencies here, Ethereum, Doge, Bitcoin. We have also commodities like platinum, palladium, silver, and we can also have bonds. For example, we have oil, German bonds, a lot of instruments for you to use. Here you have main screen where you can see charts, and here you can see your positions on the bottom and the toolbox window. Charts, you can switch here on the tabs on the bottom, and I will show you a few interesting occasions in general, how to look at the charts, how to look at the platform. So this is, for example, DAX, German index DAX. You can see candlestick chart. You can switch between bar charts, candles, and line charts. Probably line chart is pretty common to you if you don't have a trading experience, because line chart is pretty basic. But on the Forex market, mostly we use in trading, we use candles. Why we use candles? Well, I will talk about it more on the advanced webinar, more advanced webinar on Friday. But in general, it would be nice if you would read this book of Steve Neeson about candles, because you can really talk about candles for hours, and just scratch the surface there. You can customize the charts as much as you like. So, for example, let's go American dollar, Japanese yen. You click with the right button, you go chart window, and this is the chart that you get by default. That's how it looks like. And you can customize it by clicking with the right button on the platform here, properties, and then you can change all the colors that you want to make it as convenient for you as possible. And this is mine. Prime quotes, colors, red, blue. Uh, and also, if you spend some time in front of the charts, you would prefer to use dark colors because your eyes will not get tired after looking at those for many hours a day. If you choose, for example, to be a day trader, or for example, at the very beginning at the learning stage, when you will look at the charts a lot, then you would prefer to use dark colors. This is how the chart is displayed, but what does it mean one candle? Well, here it's H4 chart. It means that it's 4 hours trading. So one candle shows you what happened during 4 hours of trading, and you can switch, for example, to D1. This is daily. So one candle shows you what happened during 1 day of trading. Just to tell you how it works, in this case, in my case, blue candle is a bullish candle, which means that the price rose in this particular time, and red means that the price went lower. The body, this thick part of the candle, shows you that the opening and closing price. So a day means first price of the day and last price of the day. So, for example, this one, you can see that almost from the very beginning till the very end, the price was going lower. And you have also this thin part of the candle, which is a thick, which is a weak, sorry, or a shadow, if you will. And this shows the maximum or the minimum of the day. Maximum is on the top of the candle, minimum is on the bottom of the candle. Okay, so here you can see that pretty much from the very beginning till the very end, the price was going lower. But in this candle, you can see that we opened higher. In the meantime, during the day, the price reached this low and then reversed and closed here, slightly lower. So, and this gives you an information. As a trader, you will learn to read those Japanese candles, and you will be able to use it in your advantage. And now they may look random to you, but after some time it will make sense. And those candles will help you to navigate the market and make crucial trading decisions. Like, for example, this candle is a hammer. Hammer is a popular reversal formation, drop, reversal, upswing. If you knew hammer and you was here the next day, that would be a good occasion to buy, and was really a good occasion to buy. Now, what is that? Why this rectangle is here? This white rectangle is here. Well, it labels technical formation. Technical formation is another huge thing of trading. So if you were wondering 20 minutes ago when I was saying that market movements are random, if you are wondering, okay, so how can I trade? How can I know if the price will go up or down? Well, you cannot. You never can be sure what will happen after placing a trade. You never can be sure where the price will be tomorrow. But the thing is that market price forms formations, patterns. And if you will be able to recognize those patterns, you will be able to place bets, trades using an edge. So this pattern here marked with a white rectangle, and this is head and shoulders. So you have a left shoulder, head, and a right shoulder. And it's a very popular trend reversal pattern. As you can see, it emerged from the chart and I highlighted. Why the price is not dropping? Because, first of all, head and shoulders works when we have a breakout of the neckline. Neckline is the base of this formation here marked with the yellow color. So after the breakout of the neckline, the chances for the drop will be higher. That's the first thing. The second thing is that none of the patterns work 100% of the time. So what's the fun with patterns? It means that generally speaking, head and shoulders predicted downswing or created a downswing or started a downswing, let's say 60% of the time. So just by knowing this, you have an edge on the market, because then once you're gonna see head and shoulders and then it's gonna be a breakout of the neckline, that's a sell signal for you. But then you never can be sure, you never can be certain if this time it will bring you profits. In general, in the long run, it brings profits. 60 out of 100 trades. I'm guessing it can be 70, it can be 52. Nevertheless, more times head and shoulders works than does not work. But it does not mean that it will work this time. So the price can break a neckline, give you a proper sell signal, you can go short, and then the price can reverse and go higher. Why? Because price can do whatever the price wants. Simple as that. That's why you need to protect yourself with a stop loss order. That will cut your losses once losses are still small. If losses will become too big, you can wipe out your account, and we don't want that to happen. Simple as that. So here you can see that I'm waiting for the breakout of the yellow support. Breakout of the yellow support will give me a signal to sell. If I don't see a breakout, I don't trade this head and shoulders hoping that I'm going to see a breakout. No, in trading, there's no hope. There is only flawless execution of your edge over the market. And my edge, in this particular case, my edge is that I know that breakout of the neckline will give us a signal to go short. Simple as that. Now, maybe let's discuss those trades that I have open. American dollar to Canadian dollar, but let me open you like this. Chart window. I have my template, Prime. And tools, options, show trade levels. Yes, I always do without this. But that's my opening. Buy 2 lots here. Stop loss is here. Remember that I told you that inflation influenced the Canadian dollar. It did. This is the reaction for this inflation. Inflation was slightly lower than expected. What doesn't mean that inflation was lower than expected? Lower inflation means that there is no pressure to rise interest rates. It means that we can actually lower interest rates. Lowering interest rates, in theory, decreases the value of the currency. Rising interest rates makes currency more expensive. That's why it should go higher. So in this particular case, lower inflation decreased the demand for the Canadian dollar. So traders started to sell dollar. This is American dollar to Canadian dollar, which means that if you sell the second pair, it means that you buy the first one. That's the reaction here. You can see I open here, my stop loss is here on $400. That's really small position. Really, really, really small position. Why I opened this trade? Because you cannot just open just like this, just randomly open trades. It doesn't work like this. You need to have a system, you need to have an edge over the market, you need to have a strategy, and you need to have a reason to open a trade. So what was my reason to open a trade? Let me explain it. First of all, uptrend line. Maybe let's change the color. This is uptrend line. Uptrend line means that price is making higher highs and higher lows. It means that the price is advancing higher. It means that buying is more reasonable. Always go with the trend. What kills traders is that they try to go against the trend. No, we should always go with the trend. Pretty simple. Then, as you can see, you have a resistance here, resistance here, resistance here. After the breakout, resistance becomes a support. Maybe let's change the color. What is a resistance? It's a price area, not a single price, but generally an area where the price wanted to climb higher but bounced off this area and went lower. Resistance. What's a support? Support is a price where is an area which helped the price to bounce, stop the downswing, supported the price, and allowed the price to go higher. Okay? Broken resistances often become supports. Broken supports often become resistances. That's universal truth of trading, and this is how it works. So this was a resistance here. What was that? December, March, April. In the middle of April, the resistance got broken, and it acted as a support at the beginning of May and now. So look, the price here is bouncing off horizontal support and dynamic support. So we have two supports in the same place. That looks like a good occasion to buy. Another thing is Fibonacci levels. Also, I need to change the colors of the levels. Let's go with white. Fibonacci levels, that's a pretty advanced concept. So I will not go into the details, but you need to know that Fibonacci principle exists on the market, and that's an uptrend, and that's here the correction of an uptrend started, and the correction often stops on 38.2 Fibonacci. That's all you need to know for now. So we have three supports, and the price really bounced off those supports, and here with a help from inflation. So we have a combination of technical analysis, those charts, that's a technical analysis, was showing us that the price should go higher, and also fundamental analysis. It shows us that the price should go higher as well. So pretty clean setup. I have also one position on American dollar to Swiss franc. So let me show you American dollar to Swiss franc, explain you this, and that will be the last thing that we will do today. I don't want to tell you too many things, overwhelm you with the knowledge. We're gonna stay in touch, of course. You will come on the webinar on Friday. And then we will continue our cooperation. You will be following me on Twitter, Telegram account, where you will be able to see my trades, etc. So, American dollar to Swiss franc, I have a long position here, pretty good one. Already stop loss is on profit, which means I will not lose on this position. Stop loss is already protecting me $547. Why I opened this position? Clear, 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 support. Let's go with H4. So the price was going higher, 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 and found a support, 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 and tried to break this support, broke below, and then quickly reversed. This breakout below and quick reversal, that is a false breakout. A false breakout usually leads to the movement in the opposite direction, in this case, upswing. Okay, so I saw this and I opened my position when? 16th of May. 16th of May is Thursday. So you can see I keep my positions open for a few days. I open here and since almost very beginning, the price was going higher. So as you can see, I'm protecting $500 where I will close my position maybe here. That's take profit, $1,800 profit I would like to have on this position. Why? Because the price can go test this high here and then reverse and then do a correction. Can, but does not have to, but it would be very reasonable for the price to do this. Okay, so this is my my trade. I also have a trade on Dow Jones, which is currently on zero, on small loss. This is counter trend trade. I don't recommend you to do this. You should always go with the trend. This is counter trend trade, but low risk and potentially a really nice profit because it's a reversal trade based on also on two candles, shooting star and bearish engulfing, and I look forward for the reversal. But I will not be surprised. I will not be surprised if the price would go higher because that's what the trend is, and the price is generally going higher. So, my friends, thanks very much for attending this webinar. Remember that we are going to have wait a little bit. Okay. Okay. We're gonna have a webinar on Friday, so make sure you will attend this webinar on Friday. We're gonna carry on with more advanced concepts. I will also sum up my trading for this week. Hopefully, I will be able to show you some nice profits, and we will discuss about trading deeper, right? More advanced concepts, as I said. Now, as for the start, I think it's enough. Thank you for participating, my friends. Again, let's see each other on Friday. If you want to start trading demo account, contact Prime Quotes people in your country, our support, and they will help you with all the steps with opening an account. And also on Friday we will talk more about following each other on Twitter, on Telegram channel, etc. So thanks very much, and again, see you on Friday.